Hi, I'm Linda Eedes, and I'm going to give you an update on the RECM Equity Fund. I'm going to look at the first quarter of 2017 and the performance of the fund, how that came about, and then I'm going to talk a little bit more about how we position currently and going forwards. So looking at the first quarter of this year, it was a very good one for the fund. The fund again outperformed its benchmark, which is of course the JSE All Share Index. The fund returned 5.3% during the quarter, and the JSE All Share Index returned 3.8%. Now that's quite surprising, I think, the fact that equity markets were so buoyant if you consider the sort of political backdrop that we saw during the first quarter of this year. The fund benefited from, again, the resources exposure. What we saw globally and locally was renewed positive sentiment with regards to global growth. That saw industrial metal prices rising, and that had a very positive knock-on effect for emerging markets in general. So emerging markets actually as a whole were the top performers globally versus developed economies, which also did quite well, but not quite as well as the emerging markets. And South Africa followed suit. And I think it's quite interesting to note that despite the fact that we had all this sort of negative news with regards to government and the sort of anticipation of the credit ratings downgrade, the rand actually from the start of the quarter to the end of the quarter in fact strengthened. So looking at the performance of the various sectors within the South African equity market, resources were again a very strong performer, particularly those companies whose fortunes are linked to industrial metal prices, which rose the most. In fact, energy as a sector was down because, of course, oil prices actually dropped during the course of the quarter. There were a few concerns with regards to oversupply, and that had quite a strong dampening effect on some of the sort of more energy-related stocks in the portfolio, like Sasol. But the resource stocks like BHP Billiton, Anglo American, Merafe Resources, Centula were all up strongly during the quarter, and that, of course, contributed to returns. Banks, with regards to the credit ratings downgrade, which was to come thereafter, were down, as you might expect. So stocks such as Standard Bank, which were already in the portfolio, did come off a little bit during the quarter, but it also gave us the opportunity to introduce a new holding into the fund, and that was Barclays Africa Group. And that basically is a business which now is attractive at current prices, with a little bit of negative news causing all the banks to really come down quite a bit. In fact, the whole banking sector was down about 8% during the course of the quarter. Industrials were a bit of a mixed bag. It seems that those that were more sort of domestically oriented, which could be considered more sort of South Africa incorporated type businesses, did feel sort of the negative effect of the political uncertainty, and so that did have an effect on businesses like Invicta, for instance, which did come off during the course of the quarter. It did also give us an opportunity to buy another new investment into the portfolio, and that was Grand Parade Investments. And that business has been struggling a little bit with a few management issues and also struggling to really convince the market that it can deliver acceptable returns on the brands that it's bought most recently, such as Burger King and Dunkin' Donuts and Baskin Robbins and the like. So looking at the positioning of the portfolio, the first point I wanted to make is that the fund is positioned very differently to the market. If you want to outperform the market, you have to be different to the market. You can't be the same. And as it turns out, we think the market, particularly at this point in the cycle, has some significant risks. If you look at some of the biggest constituents of the All Share Index, they're trading at very, very high valuations, great businesses. But the reality is that if you buy them at current prices, we just don't believe you stacking the odds in favor of future investment success. So in actual fact, we think that particularly now it's a good thing that we do look different to the All Share Index. And you can see that in this slide here. If you look at the graph, the yellow bars are the positions in the fund across each sector, and the black bars represent the All Share Index. And the first thing that you can see is that we hold quite a large position in investment holding vehicles, namely RECM and Caliber and HCI. Those are the two main ones that make up that portion. And both of these give you very good access to portfolios of good assets, trading overall at significant discounts to what we think are these businesses' intrinsic values. Now, the next material difference is that we hold far less financial stocks than the index. Anything that's priced off the interest rate curve, and that includes things like insurance companies and, for instance, things outside of equities like bonds or property for that matter, is vulnerable. We all know that interest rates have been artificially repressed by monetary authorities worldwide for quite some time, since the financial crisis. So frankly, anything that's priced off the interest rate curve is expensive, and we believe at serious risk of capital loss. We own far less consumer services and consumer goods than the All Share Index. And a lot of retail and media companies fall into these sorts of buckets. Now, these are great businesses. They're high quality, consumer oriented, steady, sort of stable growth companies. But unfortunately, a lot of those stocks are priced for very good outcomes. And we don't think that those are sort of likely to come to pass. They've been priced on the back of very, very low interest rates. So if you have businesses which have stable cash flows going into the future and you discount them at incredibly low rates, you get a present value which is inflated, and it gives you a valuation far higher than you would otherwise be prepared to buy these businesses at. So we think that's a significant risk. You can see that we quite substantially overweight industrials. And now here we're talking about sort of the, as I said before, SA incorporated sort of domestically focused industrials. And they've been through an incredibly tough cycle, and they're priced very attractively as a result. It's also important to mention that many of these are mid and small cap companies. And, these opportunities are just not available to much larger asset management companies. So at RECM, not only do we have the willingness by virtue of our philosophy and the way that we invest, but we also have the ability to invest in these stocks. And that's a huge benefit to our investors. We have a very, very wide opportunity set to look for these value opportunities. If you look at the top 10, you can see it's a nicely diversified group of companies. You've got the investment holding companies I mentioned, RECM and Caliber, HCI. You've got the two biggest platinum producers in the world, which we still think are attractively priced relative to their fair value. You've got telecoms company, MTN, local bank, two turnaround situations. You've got technology group, Altron, mining company, Centula. And then you've got our good old faithful luxury goods company, Richemont. So it's a lot more diversified than it would have been 2 years ago, when about five or six out of these top 10 would have been resources businesses. And that's very positive because it means the opportunity set has widened, and we're not overly reliant on any one particular investment theme or thesis being proven right within a particular frame of time. So looking at the sectoral exposure, you can see the fund is quite evenly balanced now between financials and resources and industrials. And sort of consistently, as they've rallied, we've pulled back the resources exposure. That sector's continued to perform well. Those share prices have risen far closer to their respective fair values. So resources now are just about a third of the equity exposure in the portfolio. So to conclude, the RECM Equity Fund is a robust, well-diversified portfolio of local value opportunities. That return to value, that sort of shift in favor of value investors and that sort of investment style over others is happening. It's quite evident in the returns that we're seeing over the last sort of year and a half. There are significant tailwinds which will see that continue, we believe. And if you look at our portfolio relative to the market, it's very, very different. We believe that's to huge benefit of our investors. And we have a very wide opportunity set to take advantage of. And as I said previously, we're not only willing to take advantage of that, we're able to take advantage of that. Thank you.